You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it's time yet again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-expanding Options Insider Radio Network. If you haven't checked it out yet, listeners, tune in very soon to our latest addition to the network, Options Oddities. We record it every day live over there on the TD Ameritrade Thinkorswim platform. So if you're a TD client, surf on over there. We'd love to see you. We do it around 1:30 p.m. Central in their swim lessons room, so you can check it out live. Follow along with some screen charts, some graphs, and our fun banter there on the show every day. So join us there, 1:30 p.m. Central. We'd love to see you. Of course, you can find it wherever you find your favorite Options Insider Radio Network programs, including our mobile app available for iOS, Android, and the Fire OS. No shortage of ways for you guys to keep in touch with all the latest additions to the old network. And I am joined today on the old Volatility Views panel by my two partners in crime, starting off with the man who is gallivanting throughout the East Coast. We don't know where he's dialing in from today, from an undisclosed location in a bunker, perhaps somewhere in central New Jersey. Ooh, I've said too much already. None other than Mr. Jared Woodard, the research major domo over there at BGC Partners. Jared, welcome back to the program, sir.
Thanks. I'm glad to be back. Glad to be with you. It's really cold here in Mahwah, New Jersey. A lot of computers around me, and things are happening very fast here.
Mahwah. There you go. You guys walk down the street, hang out at some data centers, do some co-location. It'll be fun.
Absolutely. This is where it's all happening. No, I'm just kidding. I'm not there at all. But I'm on my way to New York, and I'm glad to be with you today.
All right. And a little bit past New York, way up there in the hinterlands of LL Bean country, a.k.a. Maine, we are also joined by the rock lobster himself, Mr. Andrew Giovinazzi from the pit. Mr. G, welcome back to the program, sir.
It's good to be here. I guess without Mark in this week, you have me pretty much all week. So the listeners are getting a huge dose of Maine and a huge dose of me this week. Hopefully it's working out for them.
It is a mega Andrew G dose. Hopefully they can handle it. That's the nice thing about on-demand radio. They can parse it out however they can handle it. So if it gets a little bit too much, by like midweek, they can pause it and come back next week. You know, it's always there for them.
It's available.
Yes.
How they choose.
And I'm glad you guys could join me on this very special birthday edition of Volatility Views. It is my birthday. I'm indeed 74 years young today. Just teasing. But I can think of nothing that I would rather do on my birthday. Well, perhaps a few things. But aside from those, nothing I would rather do than dive into some volatility. So let's do it and dive right on into some volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, you know what that music means. It's time for the Volatility Review, the portion of the show where we tell you what we were watching, what caught our eye in the week that was from a volatility perspective. And Jared, this is usually a portion of the show where I dive into some summaries here, but you haven't been on for a few weeks now, so you have a lot of summarizing to do. I'm sure a lot you want to catch the people up on. So I'll give you the floor, sir, at the top of the show here. What caught your eye? And we can do last week, of course, because that's where we're talking about here, but you weren't on the week before, so if anything caught your eye the week before too, feel free to enlighten us, sir. The floor is yours.
Let's talk about that really shallow, really fast dip that we had, and how quickly it got bought, and how confident everyone is still again this year in a situation where every single chance for the market to decline, for implied vols to rise, gets bought by investors overall, and volatility gets sold, even down to the level of short interest versus open interest in the shares of the volatility ETNs and ETPs. We saw the same kind of pattern play out there. I think that maybe depending on what your positioning is, that can be a good thing or not. But I think it's just remarkable how closely the market has followed the textbook that we've been trading, for the last year or so. It's hard to see what's going to change, but I think that's what stood out to me over the last week was how it is a kind of a summer market, and so you don't expect too much that's going to be remarkable. But just the way in which the market moved in the pattern that we've seen, I thought was pretty interesting.
All right, and Mr. Rock Lobster, same question for you, sir. Over this whole week that you've been just dialing into the network aggressively, what has caught your eye the most? What really piqued your curiosity from a volatility perspective?
How cheap October those October futures got. I thought the vol got index volatility, that is, as like SPX, SPY, felt like oversold early in the week, and the vol futures kind of hung up there. I think even yesterday, going into all this Yellen speak, I guess. I keep saying Yeltsin when I know it's Yellen, but
spoken like an old school 90s market maker.
I know. But we still have a lot of, we'll just call it, I think, a serious amount of future premium again. And I think the reason is because, if we don't get any action, we're going to see a lower VIX. And I think that's why those premiums are hanging up this week. As VIX tries, I think it has a good chance to go into the 11 handle again if, whatever, I guess, Putin sent his trucks in now. Finally, he got all upset, I guess, that his trucks are sitting at the border. I wonder how much time he actually spends thinking about all that stuff. He's got a whole country to run, and all he's really worried about, have my trucks gone across the border yet?
It's funny. I read about that the other day, and some journalist or someone was opining on the fact that if you looked at nothing but the media coming out of Russia, you think Putin does nothing but ride around shirtless on horseback all day, and pretty much and just pose for cameras, and you think he has no other time for state affairs because he's so busy posing on horseback without a shirt for whatever reason.
I think it does sound awfully funny to me, to be honest. But hey, if anything, like last week, that activity launched VIX cash to 15, like from 12 to 15 in 2 hours on Friday. This week, VIX cash is up 7 cents. The future premium is still pretty robust. Obviously, there's trades there and things like that. But from a vol point of view, maybe we could see lower numbers again. Because we still have that, realized volatility is in the tank again, still. We still got that sort of mid-single digit volatility. And the only thing keeping it up right now, the 10-day volatility is 6% in the SPY. It's going to be hard to maintain the 12% VIX that we have right now. But unless you get some action out of like the Ukraine. Because like I said last week, once the bombing started with the ISIS guys, that kind of turned the table on the Middle East, brought a lot of that uncertainty premium down to some degree. They're having a little more success with that. And, we just have our resident crackpot in Putin, and that's about it. So
what you're calling for is me to send some jets into Russia. That'll send the VIX down, right? That'll calm things down.
I don't think you're going to send jets into Russia, but obviously the sanctions are kind of useless. And they're going to have to do something. If they're serious about getting him out of there, then they got to do something. I mean, they have to really put a squeeze on the Russian economy. I don't know if they can do it.
I was thinking about this in the sense of where, looking about Western interest in Ukraine, it was not that long ago that the default template for the struggle there was about whether Russia would sort of have and keep Ukraine in its sphere of influence overall. Now we're talking about whether Russia will keep, even in a bad case scenario where they keep most of eastern Ukraine in their sphere of influence. So from the standpoint of where we were, 6 or 12 months ago, this doesn't look like any kind of real disaster. If anything, it's a net gain maybe for Western interests. And my feeling is that if you reach some kind of a uneasy stalemate where there's sort of minor skirmishes here or there and troop buildups and drawdowns, I don't know if we have to have any kind of resolution for people to just completely move on from this with respect to market and risk positioning.
Yep. That's what at least vol indicators say now, except for maybe Treasury bonds, which are a little skittish, which I think there's some serious worry about. It's not worry, it's just the fact that rates might not go down. But I thought a lot of that buildup in Treasuries was possibly this Ukraine worry, but I'm thinking now it's not. So, but yeah, you've got you just have lower volatility, and the only real premium in the market is in the futures, is from what I can see. Other than that, implied volatility in the cash indexes is rich on a relative basis.
I like it. We've reached the sphere of influence discussion here on the show, which is, of course, welcome to the Otto von Bismarck cast listeners for 2014. I love it. Let's have a whole sphere of influence debate. I can go down that rabbit hole for a while. But you mentioned the futures, Andrew. I want to dive into that a little bit because, of course, it was settlement week this week. On the 20th, actually, we saw the August settlement come in right around 12:15. I know last month it was a bit of an aberration there. They settled the July at 11.03. A lot of people up in arms about that. It was very, very low. Some might say even too low, outside the range of what we had seen trading. This month, it seems to have been a little bit more in line. People don't seem to be as up in arms. I mean, there's always a little bit of umbrage, a little bit of outrage around VIX settlement. That's kind of just the way the product rolls. But this month, and maybe correct me if I'm wrong, Andrew, if you disagree, maybe we'll have a little counterpoint going here, a little crossfire going. But it seemed like this month's settlement a little bit more in line. Do you take any undue umbrage to the 12:15 settlement this month?
No, I thought that was about that actually was relatively fair, which was strange, but it was.
Yeah, it was pretty much right in line as we're recording this today, listeners. Friday, August 22nd, the best day of the year, of course. We are the VIX cash hovering right around 11.84. It's at a weird range, mostly 1170 to like 12.5 this week. A little bit of a aberration here on my screen, a little bit of a gap up to a little over 13. I think that's just an aberrant print we saw there because it lasted all of a millisecond. So executing that or removing that, excising that from the chart, it was a relatively staid week for the most part from a VIX perspective. Moving on to the old VIX options, as we are wont to do here on the show. And AUG pretty much, as we expected, AUG pretty much gone from the charts here. All Sept all the time. Surprise, surprise, all calls all the time until you get all the way down to the number 9 spot with the Sept 13 puts. But it is all Sept, except for a little bit of Jan and AUG sneaking into the top list today to the tune of the number 1 spot. The Sept 19 calls coming in at 273,000 contracts, followed on the heels of them by the Sept 20s with 230,000 contracts open. Sept 16s, 226,000. AUG 16, so a few other month flavors sneaking into the top 10, 223,000 open on that strike. Sept 21s, 214,000. Then all the way out to Jan. The Jan 20s for 213,000. Nice to see some mixing it up there in the expiration cycles in the top VIX options. Then the Sept 17s for 210,000. The Sept 28s, the ever zealous, ever optimistic Sept 28s, 186,000. And then the Sept 13 puts at number 9 for 155,000 contracts open on that strike. And rounding out the top 10, the Sept 25s, also a wee bit zealous there for 150,000 thousand contracts, roughly in the top 10, about 5.7 million calls to, or overall actually in VIX, about 5.7 million calls to about 1.35 million puts. So once again, VIX, as always, very, very top heavy, very, very call heavy. And in particular, what caught our eye this week, looking at the legion of trades, even though it's a light month overall for options, light month overall for VIX, still some interesting trades lighting up the tape out here. And we caught a interesting call spread going up out here in the VIX. I believe it was on Tuesday, and we saw the OCC 16 Jan 20 diagonal going up there 134,000 times, so a very, very substantial trade there. OI on both of those strikes is below 50,000, so opening paper on both of them. Seemed like paper was selling Jan and buying OCC, which is kind of interesting. Of course, those two contracts as a time spread in VIX, you have that VIX futures term structure, the OCC and Jan settling to different futures, so you have a little bit of an interesting play going on there. Obviously, the OCC future will respond a little bit more aggressively to some near-term pop, so if there is a pop in the near term, that OCC future will pick that up. This guy obviously scooping that up for some interesting size. Did you make notice of that trade in your weekly unusual activity palooza, Andrew? Did that one catch your eye? Pretty sizable call spread out there in VIX.
You know what? That was an earlier one, and I didn't write it up, but yes, we did look at. It was like a huge Jan OCC, right? We actually created sort of a similar trade by buying OCC call spreads and selling Jan call spreads. That was a little more margin friendly. But yeah, it looked like somebody wanted that the OCC. It just got too cheap. It got oversold, and it's flexed back a little bit since then, but not too much. That's a trade where basically you're just sort of you're waiting for the October debacle to kind of in October everything gets ugly, and I believe that's kind of what that trade idea was for, and I think that's what that customer was doing. It will probably make money. That spread is in positively about 5 cents a contract so far, so it hasn't come in a lot, but it's certainly come in the right direction so far.
There you go. Take it all off for 5 cents. That'll pay for everything, right?
Exactly.
We've seen some weirder closing going on this week in the unusual activity we profile, so nothing would surprise me at this point. Someone taking off roughly 270,000 contracts for a nickel. Why not? You've made your money. Time to go home.
Time to go home. So, but he can ride the volatility down a ways on that and still have that spread work in his favor. So I thought it was a pretty smart use of the term structure. So you can see what Jared thinks about that, but I didn't think it was dumb. I thought it was a very smart type of trade.
Yeah, that's why I wanted to highlight it. Not so much the size. The size is interesting, of course, but also the way it is playing up the term structure. VIX, a bit of a unique product to a lot of the ones we talk about out here where they do have that futures term structure. It's not like an equity where you just have the stocks or you're just trading the options term structure. You're essentially trading off two different underlyings there. So that gives it a little bit of added juice, a little bit of added interest, I think, for our analysis. Jared, what's your take on this fairly sizable diagonal here in the VIX?
Yeah, I'm a fan. I mean, I think that especially when you've got so few obvious directional catalysts to trade, that if you find anomalies in the term structure, you think that something's going to either mean revert or break out, in terms of where the curve goes. I think these are fantastic trades to look at, and it does seem like they've been picking up in some size over the last few months, and that might just be, with nothing better to do in terms of hedging. Buying the calls and getting long VIX outright has been so expensive that maybe these term structure plays, in either direction, are more attractive on a cost basis.
And speaking of more attractive on a cost basis, that also brings us to the VXST, the short-term VIX. Always very attractive from a premium perspective because they are indeed the short-term contracts. And we've talked before how this product not really catching fire of late, but it seems to be getting a little bit of interest over the past week. The product had an interesting range from in the mid-13 handle all the way down to 10.5 or so, a little bit south of that this week. So it's been a bit of a range for VXST, and we also have seen some actual action going up here as a result. Looking at the overall volume of late, we saw some pretty sizable ones, particularly going up yesterday. The AUG, these expire on August 27 here, the 17 calls going up 1,500 times yesterday. Looks like pretty much on the bid, so they were dumping some aggressive paper out here. But 1,500 lot, that's that's essentially the ADV of that product on a typical day, going up just in that one spread, or excuse me, that one sale. Then we had the AUG 12 halves, 14s, 14 halves, all going up 200 times as well. Could even be in a bit of a funky fly there. I'll have to dive into that one a little bit more. Well, a total of 2,200 contracts going up yesterday, so that's substantially higher than we've seen of late there. So a little bit of love filing into the old VXST. Interesting stuff. Andrew, have you been watching? I know you on recent shows have said, yeah, we're watching, but it's not really there yet. It's not really liquid enough to dive in yet, so we're kind of playing the wait-and-see game. Is that still the case, or have you decided perhaps to dip a delicate toe into the now suddenly perhaps more interesting waters of VXST?
There's still no toe in there.
Coward. Put on that LL Bean boot and dive in, sir.
I know. Put on my waders and get in. In reality, I prefer to play short-term VIX type swings just with SPY straddles, just going after the actual, implied volatility at the money. If I'm looking for a pop or something like that, because I like the extra gamma I get with the individual options. The VXXT, there's still a good amount of slippage in the futures and stuff like that. So it makes it, there will be a day when I think the trade is interesting, but right now it's still, it's still a tough one. That's all I can say, really.
Jerry, what's your take on the ongoing saga that is VXST?
Yeah, I mean, I got to go with Andrew on this one. That chicken egg problem doesn't go away or get any better with time. You have to have a constituency for it, and some people willing to quote tighten of spreads, and to get either of those, you kind of have to have the other two. So, I think everyone's on board with the construction and the use cases, but it's just missing that one extra piece of a real natural group of participants.
I should mention, too, listeners, that 1,500 lot actually is going up today. I said yesterday, but it's going up today, Friday, August 22nd. Indeed, the best day of the calendar year. Mark your calendars every year, listeners. August 22nd, the big party that is Volatility Views. All right, moving on from VXST to touch also on the land of RVX. We're still waiting for this one, I think, to diverge again from VIX. That's where we saw the lion's share of the paper, the lion's share of the open interest about a month or so ago, when we saw RVX really starting to catch a bid and catch some life. And that divergence between VIX and RVX became substantial. And we saw a lot of size paper coming in to really try to play that, straddles, strangles, all sorts of crazy stuff going up in RVX. RVX has since come off a little bit. That premium really isn't there right now. So as a result, we're not seeing as much of a play of new open interest. The biggest, most active strike right now are the Sept 30s, fairly aggressive. They're open right around a 200 lot, and it kind of filters down from there. So interesting stuff. We're still playing the wait-and-see game with this one as well in terms of RVX. Again, once that divergence seems to come into play, it seems like RVX is going to catch a bid, as well as all these people are circling it from an ETP perspective. I think once a few ETPs launch out there, and a lot of people like that first-mover advantage of being the first ETP to trade in RVX. They've seen what happened with VIX ETPs. They want to replicate that on the RVX side. So whenever we have that first-mover advantage kicking out in there, that's certainly going to bring some paper to the fold as well. So a lot of interesting stuff going on out here in RVX. Oh, excuse me, let me rephrase that. So perhaps a lot of interesting stuff to come down the pike over here in RVX. We keep tuning in every week, waiting for that divergence to kick us a little bit more paper. Before we move on to some of the other asset classes, I just want to make a note here. Jared, I know you pay attention to a lot of the research coming out on the VIX side of the fence. That is indeed your bailiwick. That's why you're on this show. After all, you are the research major domo when it comes to volatility. And you saw our friend Buzz Gregory over there at Goldman likes to throw out a lot of interesting statements about volatility in VIX, and he and Steve Sears were writing up his recent study where he tried to, and this kind of hits on what we've talked about on the show in the past, VIX as a product, the pure core implied vol of the S&P versus some of the myriad other components that seem to pull and tug at the VIX these days. And what Buzz Gregory is saying here in his Goldman study is that he's actually finding that some of the other elements are perhaps winning that tug of war these days. He says it's caught in a tug of war right now between the U.S. economy and menacing geopolitical concerns. Against this battle of the constructive and the destructive, the VIX has averaged 16.3 in August versus a year-to-date average of 13.7. And he talks about the rising geopolitical risk and that concern adjusting and impacting the models fundamentally. And he puts all this together to essentially say at the end of the day, something we've been saying here on the show as well, is that they expect VIX levels to decline over the course of August. They're expecting about an average of 12.5 for August. Right now, we're trading about the 12.20 range or so right now, so not too far off. Have you caught this study here, Jared? And does it raise anything interesting? I mean, it seems like a lot of it is rehashing things we've already said here on the show, but it's interesting to see these getting put out there more and more into the mainstream media in areas like Barron's and others.
Yeah, I saw the thing you're referring to. My take is that there's a lot of things that can factor into our expectations for volatility in the market, and those affect the price of the index and the price of individual stocks as well, not just measures like VIX. I wouldn't go so far as to call it a kind of a new take or a new vision or a new theory about VIX or anything like that, as much as the notion that the factors that are driving risk premiums will change over time, and certainly the ones you mentioned, geopolitical risks, the interest rates and monetary policy are the big things on everyone's minds, and you can model some of that historically, and I think that's really useful to look at. But ultimately, I think it's actually helpful to start with just equity and equity risk premiums versus risk-free assets. Take that baseline case. And then move on from there to look at implieds. I wouldn't want to skip the step or anything like that, which is not to imply that the study you're referencing does that, but just that basic idea of coming up with a core model for market equity risk premiums, and then moving on from there to see like how much implieds are too rich or too cheap relative to the movement that we're seeing. Otherwise, I think it's too easy to try to pack in everything in the kitchen sink into your view about VIX, when in fact, ultimately, VIX is going to reflect the realized vol that's happening in the market. And I think that realized vol is really where investors make the biggest imprint and express the most robust views about what their expectations are.
So you're saying you would take umbrage if I were to title this episode Goldman's Radical New Vision for VIX? Yeah,
I'd have to disassociate with you entirely.
I understand, sir. So that title stricken from the record. But of course, we do like to talk about other asset classes here, other areas that exhibit vol, not just VIX land. VIX gets the headlines, VIX gets the lion's share of the love, but other things out there have volatility as well. I know a lot of you out there are watching energy and the metals. If you are, I encourage you to check out our Futures Options Roundtable program. We do that every month. Just did the latest episode a couple of days ago. It's hitting the network as we speak, so keep an eye out for that one. But there has been some interesting trajectories in both of these products. There is a little bit of a similarity, I suppose you can say, when you're looking at both of them from a volatility perspective. Both of them obviously very driven by macro geopolitical events in the Middle East and elsewhere. Both of them had a bit of a blip. A bit of a blip is probably understating it, quite a spike from a vol perspective coming into the recent events in the Middle East and the Ukraine, and have since, after that near-term spike, seemed to have settled off into a bit of a downward trajectory, for both from a price and from a volatility perspective. And both of them now seem to have caught a little bit of a bid, oil more so this week in terms of overall vol. No sizable return to the levels of a month or two ago, but still a little bit of a bid nonetheless, starting to filter into these products. Maybe people finally saying, hey, this vol has been a bit oversold in products like oil. It's time to get perhaps a little bit long premium. Maybe, Jared, we'll start with you. I know you watch a myriad of asset classes from a vol perspective. What's your take on what's cooking in the realms of the metals in addition to energy and oil?
Yeah, I wrote a couple weeks ago that it might be a little bit too early to call for a cyclical low in volatility in the fixed income currency commodity area, but that at least it looked like for the short term we might see a bit of a bounce there. And that's come true so far in some cases more than others. You see, our last update, we had gold and natural gas both looking still in the bottom third of their percentile values over the last 2 years, but certainly off the lows as well. and actually some pickup in currency implied vols, which isn't something that anyone's been able to say for quite some time. Still in the bottom decile of value, so we're not talking about a huge move, but anytime that currency implied vols aren't making new lows in this kind of market, I think it's pretty notable. So it may be that we see some continued movement in that direction, especially as a lot of people are thinking about divergence in interest rates around the world as policy starts to diverge, and I think that's going to show up in currencies and metals and fixed income as that theme becomes more and more urgent.
Andrew, what have you guys been watching over there in the pit chat this week from an oil and energy and also a metals perspective? I know you guys mostly look on the ETF side, so the much maligned USO as well as the perhaps far better GLD and SLV and those kinds of products.
The USO I looked at earlier this summer. I thought it was a good low vol product, made a little money back spreading it just because vol was so low and, just kind of holding on to the position a little bit. Gold has really been kind of dead. I mean, we have a lot of gold bugs and they're not really doing much. The interesting, I would say more interesting potential trade, just vols low and gold, except every time there's a little shock, just gold sort of drops 10 or 15 bucks or something like that, it seems like. But volatility is low. The miners have, if anything, have been picked up a little bit. But, that's about it, really. It hasn't been kind of a metal and oil palooza. Surprisingly, with Mideast unrest and all that stuff, you're just not getting the leap in volatility for this stuff. And I don't know if it's because the U.S. is a little more energy self-sufficient or we're exporting or starting to export or, you name whatever it is, but the kind of turmoil or the kind of issues we're having used to produce a heck of a lot more movement in these commodities. And right now it isn't essentially. So the fear of something to happen usually drives volatility a lot more than the actual happening of it. And there just isn't that bid for this, this kind of, we'll just call it like sort of the panic products, like going to oil or going to gold when, the world starts coming undone. So it's just, I guess, the only thing is just mostly a lack of activity that I'm seeing.
All right, and we'll wrap up here with the volatility review. But before we do that, Jared, and I know you look far afield as well into not just U.S. domestic markets, but around the world to see what's going on over there from a volatility perspective. You put it into your volatility market monitor. So what has been catching your eye overseas from a volatility perspective this past week?
Well, Mark, so one of the big themes this year in international equity implied vols was the spread that we were seeing in some of these countries where option premiums were at and staying at significant bids versus the realized volatility in the underlying stock indexes. And that dip that I mentioned at the top of the show was more or less enough realized vol in most of these cases to remove the extreme readings that we were getting for a lot of these different countries. And so in our latest update, the only equity indexes that looked especially expensive from an option standpoint were the FTSE 100, Mexico also, and Australia ranking it a little bit expensive. But places like the U.S. and Germany and Japan all had kind of alleviated the extreme conditions that had persisted through a lot of the summer.
All right, great stuff. And that's going to do it for the Volatility Review, listeners. And now, because we love to hear your input on the old program, we're going to keep on rolling right on into the Volatility Voicemail segment.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility Voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
You know, it's funny. We set this segment up as the volatility voicemail segment, and a lot of people love to write in and join on this segment. And as the man said, no shortage of ways for you guys to do that. Yet everyone seems to be terrified to have their voice actually played live on the air. Maybe we'll have to work up some sort of contest to give people the courage to call and leave some voicemail so we can hear your lovely voices here on the old program. Meanwhile, a lot of you guys writing in this week. First one's a comment, actually, and we get variations on this comment all the time, so I thought it was worth discussing here at the top of the segment. This one actually comes from the folks over there at Vizible. They make an app, a photo app, I believe, actually, for iOS and others, and apparently also big fans of the show. They wrote in and said, hey, what happened to Don S? Sorry if we missed something, but loved him on the show. Great podcast, by the way. Well, thank you, guys. And a lot of you guys write in on a regular basis, hey, what's going on with Don and those guys over at Volex? And I have to say, they are working on some cool stuff. I was just talking to them the other day, actually, but they had to kind of reposition a little bit from what they were doing over there in the Volex land. If anyone is familiar with the world of exchanges and new products, launching a new product is not a sprint, it is a marathon. It takes quite a while to get all the regulatory and all their ducks in a row to get those products listed and then get some volume and traction on them. And it's a difficult road to hoe for a startup to do all that. And that's kind of what Volex encountered. So they're repositioning a bit and working on some interesting, cool stuff. And who knows, if all that stuff works out, listeners, we may be able to get Don S. back on the show one of these days. So all you guys writing in saying, hey, whatever happened to Don S? Don't worry. We'll probably get him back. Who knows? Maybe he also is very active in the realm of blackjack, and he's a well-known expert in that side of the fence. So maybe we can get him on the network every now and then to do like a blackjack minute or something like that. Might be kind of fun. Maybe not on this show, but just in general. I was giving him a hard time about that before when he used to be on the show. Maybe now that they're not on, we could sneak in some blackjack tips. You know, always split your 11s and all that fun stuff. All right. Next up, we have a question from a listener who goes by the great handle here, NOVIX. He's listening to the wrong show then. We talk about VIX quite a bit. He writes, I've read some material related to peers trading for equities, and I understand the process of finding a non-stationary peers price series that can be co-integrated to form a stationary series. The basic idea being to trade on the oscillations about the equilibrium value of the spread. While I understand how that is accomplished with equities, I'm not sure how suitable implied volatility pairs on equity options are identified, since both implied volatility series would already be stationary, and so co-integration would not be required. Can someone please explain how suitable implied volatility pairs are identified? Interesting question here, Mr. NOVIX. He's, of course, referring listeners to that basic strategy of the pairs trade, where people do that a lot on the basic equity side, and he's talking about how he understands that. But he's kind of taking a little bit of a different spin on that and doing actually an implied vol pairs trade, which is an interesting thing, something we haven't discussed a lot here on the program on the past, so it might be an interesting opportunity to dive right into that right now. And since I can see you champing at the bit over here, Jared, you want to dive into this one, I'll let you dive in first here. What do you have to say for our friend, Mr. or Mrs. perhaps, NOVIX?
Let me jump. So they asked, how can you identify suitable pairs? And I actually like to take that question from a different direction, which is to be really practical about it. And let's say that we just assume that we can identify with a lot of confidence some suitable implied volatility pairs that we want to trade. Because knowledge is great, but if you can't execute it and make it practical, then it remains purely academic, right? So thinking about this, let's say that there's some stocks that you've identified that have implied vols that you expect are going to mean revert or something like that. One of the limitations of this type of approach is the fact that there are very few tradable products that have both constant maturity and strike independence. So, for example, one of the big innovations for the VIX index is that the methodology to calculate a VIX measure is independent of any strike price, right? It takes strikes from all over the curve. Additionally, it uses a constant maturity approach so that you're not, just working with one series of options that's going to expire on you. And so that's really ideal if you wanted to trade something like a pairs trade, since it gives you the kind of smoothness and consistency across time and strike that would allow you to profit from those changes in implied vol. Like I said, there's very few products that meet those criteria, and so what you end up with is having to execute at very discrete, both in terms of time and in terms of strike price conditions that make it really difficult to capture any edge that you might find in implied vol pairs. And then the other limitation that I would mention is that because carry is such an important part of these type of strategies, especially if you're going to trade options that are 2 or 3 or any more months out than that, to give you enough time for your thesis to play out, then it's important to hedge the realized volatility component of the trade. And so now you're talking about trading implied against realized in multiple underlyings, which again is something that is easier to do if you have constant maturity, strike independent products. But in the absence of those, you're talking about, pairs of put and call spreads that you have to size in appropriate ways. And it's an extremely complicated type of trade to do. And so I think that in terms of a research agenda, actually tackling the practical aspects of that approach might be the most important item.
Yeah, like a lot of these strategies we talk about here on the show, the devil really is in the details. And like you said there, Jared, actually isolating the pairs and doing all of the management and the hedging that you need to do to keep those pairs moving and accurately lined up to each other, that would probably dissuade the lion's share of people who want to actually do this. The equities version is so much simpler from just a pure execution and management perspective that the implied vol is really not for the faint of heart. But that said, it doesn't mean it can't be done. I like your suggestion, too, about doing it several months out. It gives you some time for this pairs trade to actually work. If you just do front month or, God forbid, VXST, not really have a lot of time for that trade to bake and to be sorted out. So interesting stuff. This is really – I would love to hear some more people out there, if you're attempting to do this, how it's working out for you and maybe what some of the methodologies are that you guys are using. Because as we just heard here, it's pretty laborious and time-consuming. You have to be pretty high-end. You have to have, notwithstanding, of course, the issues in terms of capital and margin you need to maintain those hedges. It's a pretty substantial undertaking. But if you're out there doing this and doing it successfully or even not successfully, just trying your hand at it, let us know. We'd like to hear from you. Before we move on, Mr. Andrew, any thoughts here for our friend, Mr. NOVIX?
All I say is that this is a big kettle of fish to try to trade implied volatility pairs. The only thing I would say is most likely I'm more interested when something moves out of line at first. So that being, let's say, why would one index volatility be a little higher than the other? Like, so something that comes to mind recently was like the VIX. I'm sorry, not the VIX, the SPY versus the Russell. So at Option Pit, in our chat, we put together a couple trades where we would buy SPY at the money options and sell Russell out of the money options kind of to pay for them. So you kind of own the gamma in one and sell the, we'll just call them the more out of the money, sell a few more out of the money spreads in the Russell. And you figure, if both markets move really hard, your SPY should pick up and the volatility should to converge a little bit. So the only thing I would say with a strategy like this is, I become more interested in this type of strategy when two products that are kind of similar already, indexes are a good thing, are because they tend to correlate highly when the market makes a big move up or down for the most part. So when you can start them off, when the vols are a lot different, you got a better shot, and then you just have to create the plan. So, that's the kind of stuff that we do, but just from my point of view, it usually works a little better when, like when Jared was saying, you really have the underlying products really to arb volatility have to act a lot alike. And doing it with like straight up equities, let's say in the same industry, very difficult because of the individual nature of every company. So I would say if you want to take a look at it, one of the places to look at would be in the indexes. And then after that, you have to do a little work on position structure, although a lot of, I think, the opportunity that was in the Russell is starting to kind of wither away right now. It's not something we're looking at anymore, mostly because I don't think the vol's where it was. So that's my only. You
guys are kind of doing the poor man's vol pairs trade over there by just doing the spreads and kind of doing it more straight up. And that's a more manageable, I think, approach to a lot of our listeners as well.
Well, you actually didn't have to manage it at all. You just put it on and wait.
Yeah, that's one way to do it too, listeners. I'm not sure if that's not really a technically defined pairs trade, but it's approximate enough, I think, for a lot of our listeners to do it, and it's something they could actually do in their retail accounts without a lot of.
Do it in a Reg T account without, and obviously you could, what we look at what we look at is we look at Reg T type trades, and if you have portfolio margin, you could always, if you understand how to do it, you can always add a little more VIG yourself. But we try to look at things only from the Reg T perspective because it's easier to learn that way. There's always a way to skin a cat. And I think a lot of this, unless you have, and actually we do have clients that spend a lot of time creating fairly sophisticated data to do these kind of things. If you're really not putting the time into that, it's going to be very difficult, and maybe stick to just looking at something simpler and at least watching how it moves, so you can start to gauge how this type of strategy might work for you.
Good stuff. So there you go, Mr. NOVIX. Two very, very different approaches to that same thing. So you can go hardcore, go the Andrew poor man's approach, whichever way suits your purpose. I like it. A good question there, Mr. NOVIX. We got time for, I believe, one more here on the old volatility voicemail. This one comes in from, believe it or not, Mr. T. Stark. So I'm going to assume that's Tony Stark. So yes, indeed, Iron Man is listening to our program. Actually, it is my birthday, Iron Man, so if you could maybe, I don't ask for much, maybe a set of repulsors, that'd be kind of cool. Then my little guy would think I'm the coolest thing ever. So if you can make that happen in return for answering your question, we would be greatly appreciated. I know Iron Man's such an interested fan of implied volatility. Apparently he is. When he's not making iron suits, he's trading ball. And he writes, great podcast. I can't start my week without my dose of volatility views. You guys really do a great job breaking down complicated stuff so that even non-pros like myself get it. The one area where I'm still somewhat confused comes in the relationship of implied vol across an expiration month. I realize that when you say October vol is X, you are referring to the at-the-money volatility. But how does the at-the-money volatility relate to the rest of the strikes? If at-the-money volatility gets crushed, do all the rest of the strikes get crushed along with it? Or are there scenarios where only a few strikes are impacted but the rest aren't? How does this relationship work? Are there models or Greek variables that explain the volatility relationship between one strike and another? Thanks again for walking this noob through this stuff. Fan for life. Well, there you go. Iron Man is a fan for life of the show. And Tony, I'm assuming that is your name. This is something we talk about a lot on not just this program, but on the network itself, whenever, and on the website as well. If you look at a lot of the unusual activity analysis that we do on the site, this is where we really dive into the implied vol analysis on a strike-by-strike basis, because we're seeing typically activity going up on one localized strike within the monthly expiration chain. And if it's, let's say, someone dumping 10,000, what that's going to do to the other strikes around it and vice versa. And quite frequently, when we're looking at these types of trades, we're looking at the distortions that these trades are causing. Because in general, if someone's dumping a lot of vol in a month, it's probably going to crush the vol in that month, but not necessarily across all the strikes. And that's where things get kind of interesting from a trading perspective. A lot of times we see people trading upside, for example, buying a flurry of upside calls, 10,000 upside calls, an XYZ name. So they're buying them, let's say, 10, 15, 20% out of the money. But that doesn't mean that the at the money is getting bid up at the exact same levels, which in this case we like to refer to a lot as that distortion that's being caused by that unusual activity. So in those scenarios, you like to recommend things like buying the at-the-money, which is inflated, but not anywhere near as inflated as that strike that person has been buying 10,000 contracts of. And then you could sell the out-of-the-money strike and take advantage of that distortion, like you're talking about here. Take advantage of that distorted relationship between those two strikes to be able to leg into, let's say, a vertical spread in this example for a much more attractive level than you ever could before. So there are many, many examples of that throughout the day that you can find just on our website alone, of areas where these relationships come out of whack due to these distortions, and they cause a lot of interesting and fun trading opportunities as a result of that. Jared, what's your take here for our friend, Mr. Iron Man?
We could actually unpack this question, I think, for a long time. If the listener asks for models to explain the relationship, and just an area for future study, if you Google like sticky strike and sticky delta theories of how these different strikes change, then I think you'll get a long way toward probably what you're looking for. So essentially the sticky strike model is a kind of a way to try to preserve the Black-Scholes framework, kind of thinking that a change in the stock price isn't going to actually result in a big change in individual strike implied vols. And then the sticky delta model tries to maintain a curve There's also actually a sticky moneyness one I forgot about too. So anyway, we don't have time to get into all those, but there are different theories that attempt to describe how these curves change. And one of my favorite pieces on this is from a scholar named Manuel Derman, who's done a lot of work in volatility. He comes up with his own model he calls sticky implied tree, but he also gives you good explanation of the other approaches in some of his lectures and presentations, which you can find online really easily. And it gives you a sense of how different ways people try to talk about these relationships. And I think what's most interesting to me is that the fact that depending on your time frame and also the overall volatility regime in the market, you can actually observe different periods in which these different models apply more and less well. And so it gives you a sense of what to expect in terms of how those other strikes are going to change based on what's been going on recently in the market.
Great stuff. It always amazes me how much the market is willing, and the research area as well, are willing to bend over backwards to create alternative models to keep Black-Scholes relevant, because there's so much fudging that goes into Black-Scholes at the end of the day. And you're right, it does open up an interesting, fertile ground for research. Listener, I should say, Tony, if you could just go research on Google all the stuff Jared was just mentioning, you'll be reading for days about all the myriad different ways these models are applied back to Black-Scholes. Good reading for you. Mr. Andrew, take us home. What do you have to say for our friend here, Mr. Ironman?
Oh, well, I was interviewing a potential trader who actually now runs the education at a very large option house. He will remain nameless, but we were interviewing him let's just call it at a bar in Chicago somewhere. And what I decided is I wanted to see if he could understand the question of volatility surface. So I pulled out a cocktail napkin and I laid it out on the table. And I kind of picked up part of the napkin and I lifted it up, and I said, well, this is kind of how volatility works in a nutshell. You've got activity here and you see how you're pulling up the surface in one place, but the whole napkin rises sort of with it. And just when there's activity the other direction, the volatility will fall, and they're all kind of connected. And I'm like, okay, do you understand that? And this, of course, was after several cocktails, so I don't know if we both understood much of anything at that point. But he did get it. And the one way to think about volatility in a simple fashion is what is happening in one place will affect the curve, and it kind of radiates out the connections. Jared did a good job of just describing, sticky vol and things like that. But ultimately, the option model, the pricing you see a lot is based on an annualized straight line vol. So everything else is just sort of is trying to, when you're looking at volatility or volatility arbs, it's trying to get back to the kind of a simple volatility number. So in that way, if you just imagine how volatility is kind of connected to sort of where the activity is, or where you're picking up that cocktail napkin, it might help you to think of how volatility can sort of move from that point. So that's always been a popular sort of image for, trainees and clients, especially when we're in particular venues where there's a lot of cocktail napkins around. But hopefully that will help you remember how sort of volatility works.
I find that some of the greatest options analysis done here in Chicago is done in the bars around the exchanges. Great minds and a few beverages combined for some interesting results. Speaking of results, listeners, that's about all the time we have for the volatility voicemail segments. Also all the time we have for this episode of Volatility Views. We went a little long, listeners, but I like to make sure we get your questions, and you can hear us ramble all the time, but we want to make sure we hear your questions and your comments and give you guys a chance to have your moment in the sun here on the old panel. Not that Iron Man needs much more time in the sun. But before we go, let me check in really quickly with each of my cohorts here on the old Volatility Views panel, see what they have cooking that may interest you. Starting with you, Mr. Jared, what's coming down the pike over there at BGC Partners?
Well, we've been talking this year about how as the market calms down and improves, looking at individual stocks and sectors becomes more and more important as those implied and realized correlations move back to normal territory. And in order to make that more feasible, one of the things I've been working on is sector and industry specific breakout sheets that look at the key stocks in each group, what their relative volatility metrics are, some of the fundamental and valuation metrics, as a way to get a handle and a quick snapshot on what's happening in a given sector. That's been a big effort I've been making recently, and I think we're about ready to start putting those out for clients. So something to keep an eye out, or get in touch if you want to learn more.
And Mr. Andrew, what's cooking over there in the land of the pit?
On the heels of our boot camp, we're going to do more. Apparently, all that learning, people liked it. So hopefully we'll be launching new boot camps, which are basically real compact, highly compact option education series around 6 hours over a 3-day period that Mark and I teach. It seems that when we've been dealing with specific questions that clients have had and creating the boot camps around them, it seems to people really like it. If you would like a copy of our last boot camp, send me a note at andrew@optionpit.com, and we'll give it to you for a very decent price, and it also gives you a little access to the Option Pit live world. So let me know, andrew@optionpit.com, if you'd like to hear it. So basically it was a basic camp, Greeks, volatility, positioning, and risk management. So we hit a lot of targets sort of very hard with this last boot camp.
All right, good stuff. And on behalf of Jared and Andrew, and of course myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing to the show, and of course for sending in such great questions. Keep those coming, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.